Good afternoon, everyone. This is Scott Duba with Prime Capital and QPA. We're due to start here in just a minute, so we're going to give other participants another 60 seconds or so to dial in, then we'll get rolling. So stand by, please. All right, everybody, we'll give it another 30 seconds and we'll get rolling. So just stand by and we will start soon. All right, welcome everybody. It is January 24th, 2024, and this is Making Sense of the Markets, a guide for plan participants and investors. My name is Scott Duba, Chief Investment Officer of Prime Capital and QPA. I will be your host. With me today, I have Eric Kraus, Portfolio Manager, and Will McGuff, one of our investment strategists. Just to give you a little bit of background on Will, if you haven't met him before. Will has been in the financial services sector for over 2 decades in the investment realm, serving both wealth management and retirement clients. He joined us about a year ago and has extensive experience in the space, specializing in particular in core model portfolio management and manager due diligence. Will hails from Georgia and has 2 young daughters. Also, we have Eric Kraus with us. Eric is in our Fayetteville office. Or for those of you that do not know Eric, he's a portfolio manager and a wealth advisor. He hails from Missouri State University and has 2 daughters himself. And for those of you who have not met me, I'm Scott, the Chief Investment Officer. I oversee our firm's investment and trading functions for both wealth management and retirement plans. I'm from Michigan originally and go home to 5 kids. So amongst the 3 of us, we have a lot of kids and we work hard to serve our clients, therefore. So for those of you that maybe don't know the firm as well, I just want to give a quick update. We have grown a lot, and I want to make sure everyone on the call understands the capabilities of the firm and the advisor that serves you. We want to make sure that all the plan participants and all of our clients know that we're here to help. So I want to just remind people, we do serve wealth management clients, retirement plans, sponsors, and participants, as well as institutional clientele. We serve over 15,000 households, about 800 retirement plans, have a firm assets under management of $25 billion. We have 176 advisors across 60 offices who are supported by another 177 support personnel, and we serve clients in 48 states. And I shouldn't forget to mention, we think we have the best advisors in the industry, so they're always there to help. So please, if you ever have any financial services needs, reach out to your PCIA or QPA advisor. Let me zoom out a little bit and kind of set the stage. We always like to look at headlines to kick us off. We have this perennial kind of continuous geopolitical strife. We've been dealing with the Ukraine-Russia conflict for well over a year now. We're all shocked and dismayed by the terror in Israel last year, which continues to manifest itself in an ongoing conflict in Gaza. And now we have issues in Yemen. So we still have sort of this percolating angst on the geopolitical front. Despite that backdrop, we have heard about the Magnificent Seven continuously for 9 months. We're heading into election season, and the market continues to perform very well. The S&P 500 recently hit another record close. There's still a lot of cash on the sidelines in money markets, and we have the continued theme of AI driving at least a good chunk of the excitement. And you have some issues that might make you pause and think, okay, are we really driven by fundamentals here, or is this getting a little bit frothy? Case in point, the SEC has approved the first spot Bitcoin ETF, and Bitcoin has rallied back a lot, which we view as a speculative asset that might be seen as a signal for the enthusiasm in the market. So with that backdrop, I think the first question we want to try to answer is, how did 2023 market performance compare to prior years? And for that question, I'll ask Eric. Eric, maybe talk to us about your view on 2023 versus past years and what we should make of the prior year.
Well, I'm happy to do that, Scott. But before we dive into that, I'm a little dismayed that the Travis Kelce Taylor Swift relationship did not make the list of headlines, nor did Andy Reid's frozen mustache. But maybe I'll be in charge of that slide next time.
I think the fact that we have 8 daughters amongst the 3 of us, I mean, that's why I decided to leave it out. I think Taylor has enough market share in my house. I didn't need to bring her into the workplace.
All right. So 2023 market performance compared to prior years, obviously a lot better than 2022, which was a relief to all of us as investors. But a lot of it didn't really feel that way, even when we did this webinar a quarter ago. So when we ended September, the S&P 500 was up double digits, but the average investor was not. The equal weighted S&P 500 was largely flat. The Dow was only up 2%. Bonds were negative. So it felt like a year where there was some winners out there, but they were elusive. But what happened in the fourth quarter is we had a pretty significant broadening out of that rally, which was a welcome relief for all of us here. And what we can see on the slide here is that the S&P 500 ended up 24% for the year, despite going through a 10% correction in the middle of that third and fourth, or late into the third quarter. But what's interesting about this, that sounds like a pretty fantastic year, and it was, by all means it was. But if you look back at some of those major drawdowns that we've experienced recently, so the 2008 financial crisis was followed by a 23% rate of return in 2009. The tech bubble sell-off that manifested itself over 3 years was followed by a 26% recovery. So while it is a nice year, it's not atypical to see after a substantial sell-off a nice, more than double-digit into the 20 percentile range return for equity markets. If we look at fixed income markets, this again was a pretty dismal topic for us to be covering just 3 months ago, because when we closed out the third quarter, the bond aggregate was actually in negative territory on a year-to-date basis because interest rates were nearing their peak levels. The 10-year Treasury was approaching 5%. We had a 7% drawdown at some point, or at one point last year, and we were on track for making history in a bad way of 3 negative returns in a row for the bond market. But ever since we had that peak interest rate, the Fed started to pivot just a little bit, which I'm sure we'll dive into here shortly. The bond market actually ended up producing a nice solid return for investors. And what that led to, if we just go down one more slide here, is the diversified portfolios that were sort of languishing midway through the year and certainly into the third quarter ended up in pretty good shape. So most of our balanced type of investors, you can see here on the far right-hand side, that 2023 return with the white box, balanced asset allocation strategies, 60-40 strategies had double-digit returns, 13, 14%. Which was still led by U.S. large caps, but a lot of those other asset classes gained a little bit of steam, gained a little bit of momentum in a much sheer broadening out of markets.
Yeah, I think it is notable just the dramatic recovery, or rather acceleration, in the market we've seen over the past 90 days. Will, maybe turning it to you, which sectors of the equity market have been performing well? And maybe give us some context about where we sit from a market valuation and makeup standpoint.
Yeah, thanks, Scott. Thanks, Eric, and everybody tuning in. But before we drill down into sectors, let's take a look at the market, S&P 500, as it's priced at various inflection points over time. There are a couple of key things going on in this chart. What you see is highlighted are various lows and highs connected by the green dot and the green lines. And the market's price at these inflection points, along with the price to earnings ratio. So the S&P valuation or index is a function of two things: earnings per share and the price per earnings. You multiply those two together and you get the S&P's value. Earnings per share is somewhat scientific or numerical. You can measure it because that is the aggregate earnings of all of the S&P 500 companies. The price to earnings ratio is a little bit more art than science. It's what the market agrees on the valuation, or how much should you pay for those earnings. So the price to earnings ratio can change a little bit more over time, whereas earnings tend to be a little bit stabler, more stable until we're in comfortable markets. Obviously, earnings can back up or stay flat in more recessionary type environments. During the call last quarter, the S&P was at 4288 at a 17.8 price to earnings. So we're about 11% higher at 4770, and we're at a 19.5 earnings per share. So if we think about that, that's probably a $225 earnings on the S&P, and the market's projecting 243 for next year and 270 for the year after that. So it's kind of, we were bantering about this a little bit before we started. Market always likes to just start right around 10% in earnings growth, and then it'll fluctuate from there. And the last point on this slide, or talking point relative to the slide, is for 2023, with the market being up, that was driven all by price to earnings ratio going up, as earnings were kind of flat last year. So again, the market can move up or down based upon those two factors: price to earnings and earnings per share. And as we jump forward to the next slide, we'll actually get into how it goes about that. And so if we think about the market composition, everybody's well aware of the Magnificent Seven. It's a little bit different take here with the top 10 stocks, but very close. And so we can see that the top 10 stocks were up 62% last year. The S&P was up 24. That meant the other remaining S&P 500 stocks were only up about 8%. And a lot of folks kind of hem and haw over the market's too concentrated, it's too much of a risk, which you can see on the top right. The weight of the top 10 stocks is the highest it has been over 30 years on this chart. But what's interesting to me, and where you need to balance that view with, is how much the earnings do those top 10 stocks contribute. And so if we're on the bottom right-hand chart here, you can just kind of eyeball it and see that it's about the middle of the chart. So while those top 10 stocks do take up a large percentage of the market cap, their earnings contribution looks about average over time. So a little bit of contrast and information there. I don't know if that rings a bell to you, Scott or Eric. Any thoughts on that? But
yeah, I guess what I think about is two things. Number one, you are correct. I mean, the composition of earnings from the top 10 has been relatively stable in that mid-20s%, whereas the market cap, or rather the weighted average price, is up higher. I think some of that is warranted. I mean, when you look at some of these companies, they're obviously tech heavy, but they tend to have higher growth rates, higher returns on capital, higher margins, and really just wider competitive moats. When we screen stocks for our equity portfolios, there's not a lot of poor quality companies in those top 10. So I would say some of that premium to the market is warranted. The other thing I think about is it would be odd if this rally didn't spread out, or at least normalize somewhat, because there's a fair amount of tech theme in those top 10. A lot of the excitement has been around AI. And obviously, if that gets commercialized the way people expect, there will be a lot of other sectors that benefit. So I think it's an interesting thing to be aware of. I think some of the premium is warranted. But ultimately, if AI really is the driver people think it's going to be commercialized across all sectors, not just these tech-heavy ones. Eric, I don't know if you have any other thing to add to this slide.
No, I would agree with that. I think your next slide is actually pretty helpful too, just the composition of what makes the top stocks in the index. And I'll let you guys dive into it here, but there's a reason people are willing to pay more for the growth rate that's associated with AI-driven companies versus the growth rate that might have been associated with ExxonMobil or Walmart or some of the other constituents that used to represent the top 10. So some broadening out will be healthy. I think you're 100% correct that the benefits of AI will trickle down to other industries once it becomes more practical. Then people are paying less just for those initial applications. But I'd love to get your thoughts or just commentary on this shift. I thought this was a really interesting chart to show how that's shifted through the years.
Yeah, I think what strikes me is if you look back to 2010 to 2020 or 2010 to now, only 2 of these names are still in the top 10, Microsoft and Apple. ExxonMobil, Walmart, J&J, P&G, IBM, JP Morgan, AT&T, GE, those companies have all performed relatively well. I'd say AT&T, GE are an exception there. They've had some issues, primarily balance sheet related. But most of the reason why the new top 10 are different than the old top 10 is because they've grown from being formerly top 200, top 300 stocks to top 10. And so what we think a lot about is it's great to own these, dominant players, but for the next decade and the decade after that, we got to be paying attention to that next rung down. These are still multi-billion-dollar companies in the S&P 500, the S&P 490. There's a lot of good names in there, and we always want to be cognizant to have exposure to more than just the top 10 because we know it'll be different in 10 years.
Yeah. No.
Go ahead, Will.
Yeah, I was going to say I couldn't agree more, and maybe trying to jump back into the sectors like we were originally supposed to in the interest of time here. So great conversation there. So what we're looking at here now are, again, 2023 returns by valuation by sector. So the S&P 500 is comprised of 11 different groups of stocks that are called sectors. For example, tech stocks are in the tech sector. It's Apple, we're there. Communication services would be where Google is. It's they're a communication company or they're a tech company. The industry debates on what they actually are, but communication services. So the box we have highlighted in the middle are really kind of our risk on bullish sectors that are leading the charge or that led the charge in 2023. As you can see, consumer discretionary up 42%, tech up 57%, communication services up 55%. First on the far right, the S&P 500 up in the mid-20s. And as you can imagine, there's a lot going on in this chart here, but as we move towards the bottom in the green, you can see that the PE ratios are kind of reflective of that return premium that you saw. So investors will pay more for stocks that have higher growth potential and higher multiples, which makes sense there. So you see that the higher PE sectors are also have the highest returns. Now, how this may be relevant to a plan participant or one of our wealth clients is this is where our job comes in to make sure that the asset allocation is done prudently across various asset classes and sectors. So we've got sector-specific products. If you're in a 401k plan, you typically don't have many sector-related strategies there as they're more basic asset classes. But these sectors do cut across all asset classes. So whether you own a large cap, a mid cap, or small cap, they've all got some sliver of these sectors and different weights there. It's just something to keep in mind of. Speaking of asset classes, we're now going to jump into the PE ratios of asset classes. And again, I'm going to just focus you on the bottom right here. And so this is a great chart. Again, most of these are by JP Morgan. They do fantastic work. And what we're looking at here is the style box. So there's 9 basic categories of stocks. You want to hop back one. So large cap stocks, mid cap stocks, small cap stocks go up to down, and left to right are value stocks, blend, and growth stocks. So large cap growth at top right is where the Apple, Amazon, Google, Teslas of the world live. And they've got the highest PE today as a percentage of their 20-year PE. We've kind of ad nauseum talked about it. There's where the earnings are, that's what's driving the market. So investors are paying more for earnings in that sector or style box of the market. What's attractive to us is small cap and potentially even value. So you'll see small and small blend are right at 100%. One's just under, one's just over. And so we've actually If you've seen some of the tweaks in either your wealth models or risk-based models in the retirement plan business, we actually slightly increased our small cap exposure probably 6 months ago, 5-6 months ago, relative to those benchmarks. Again, asset allocation drills down with style box as well. So we think that small caps for 2024 could be an interesting and attractive opportunity with rates coming down, potential of the dollars, not growing as fast, and making small cap stocks more competitive from a valuation standpoint is something to be aware of in 2024. And then as we compare that across a bunch of other asset classes on the next slide, you'll see we've highlighted small cap here in the middle. And so this isn't a metric per se that's common that you can go find. JP Morgan did what's called a Z-score here. So a Z-score attempts to normalize data across a whole bunch of different instruments into a way to compare them all on a relative basis. So they did a Z-score approach so that they could compare various metrics for various asset classes. Sounds confusing because it is confusing, but what you need to know is that the number, you can look at the chart here and visually compare the dots and the diamonds relative to other asset classes and metrics. So that's the beauty of the Z-score, is that it is a complicated approach that makes a simplistic way to analyze data. And you can see how they've got the chart organized with the most attractive Z-score to least attractive from bottom left to top right. And you can see that treasuries, bonds, emerging markets, developed markets, small caps, all the way to US large cap is the scale there. So again, some attractiveness from just US stocks would be US small cap, US large cap. We've got bonds, which we'll talk about in a little bit, and then we're not really covering too much on internationals in this call. But there's some favorable markets internationally that look attractive as well. And so with that, Scott, I'll turn it back over to you for our next section.
Yeah, thank you, Will. Z-scores are confusing, and I like the way you summarize them. Rich to cheap. You should teach a stats class. So Eric, maybe let's dive into this one. What's been driving the markets lately? Let me take the first crack here, and you can add on. So obviously, inflation was a big story last year. It was concerningly high in 22, and we saw more or less steady progress throughout 2023. We still are not out of the woods completely. Both headline inflation in the low threes and core inflation metrics, we kind of got a lot of really good progress from mid-22 to mid-23, and we've been more or less bumping along the 3% range for a few months. But it's trending in the right direction, and it's not reaccelerating. So what this has done is it's given the Fed some air cover or some conviction, whichever way you want to look at it, to be a little less hawkish. Back in late Q3, early Q4, the Fed frankly surprised the market by the tone in which they talked about Fed rate hikes or future Fed rate hikes, effectively saying we think we're done hiking, and actually indicating that they would eventually be cutting rates before they raised more effectively. What's happening though in the market is there's a bit of a disagreement. If you look at what the market has priced in versus what the Fed has projected in their dot plot, the market's pricing in about 6 rate cuts between now and the end of 24, where the Fed's guidance would suggest it's only going to be 3. So whereas the rates right now are 5.5 times, the market thinks they'll be 4 at the end of 24. The Fed is signaling more of a 5.5 to 4 3/4. Now that 75 basis points at 0.75% might not seem like a lot, but for equity markets and valuations, it's a fairly material difference. If we step back and think about what could cause the Fed to have to cut faster, the way the market expects, it would probably be accelerating economic weakness. We haven't seen it yet, but suffice it to say the market's a little bit ahead of the Fed in terms of guiding to rate cuts. When we zoom back out, though, we like to look at history. And whether or not the Fed starts to cut as fast as the market expects or not, history would suggest that the market performs pretty well after rate hikes. Eric, I know this chart's near and dear to your heart. Maybe take us through what we're looking at here with respect to how the market's performed historically at the end of Fed hiking cycles.
Yeah, absolutely. I think we had a slide last quarter that highlighted the opportunity cost of CDs, right? The opportunity to perhaps look at other asset classes, even when it didn't feel great, when that 5.5% CD rate was very comforting relative to an uncertain equity market. And we're still kind of in the same boat. I think most of us would agree that the Fed is done hiking. We're now talking about cuts. We have to be careful what we wish for there. To your point, Scott, too many rate cuts is likely a product of higher unemployment or some bad things happening in the economy. But I've probably said this too many times on these broadcasts that the old adage of investing of don't fight the Fed still plays true on the way down also. So while it's painful to fight the Federal Reserve when they're tightening monetary policy, Exhibit A 2022 market returns, historically, both equity markets illustrated on the left and bond markets illustrated on the right have done fairly well in the 12 months following that last rate hike. So we want to be mindful of any outliers. Certainly that purple line's a little ugly down there in the tech bubble. And I would caution that the green line, 04 to 06, had a pretty nasty 07, 08 thereafter. So it's certainly not an all clear signal to say, let's go 100% risk on here. But for investors, it's not a time necessarily also to run for the hills and hide out in cash with that reinvestment risk that comes along. If those interest rates right now are 5.25 in that money market fund or that CD, if the Fed does cut rates 5 or 6 times, now we're back at a risk-free rate of 3.5 or 4. And there's probably better opportunities, at least for long-term investors, not for short-term cash alternatives, but for long-term investors in both the equity and the fixed income markets.
Yeah, and the other metric that we keep a good eye on is investor sentiment. These graphics are a little bit hard to read, but the top panels are from the CNN Fear and Greed Index. Oops, pardon me. Those look at a number of metrics to effectively come up with a speedometer that shows how greedy or fearful investors are. Right now, the last reading was about a 72. Anything above 75 signals extreme greed. On the other end, anything below 25 signals extreme fear. If you look at the panel on the top right, it was just last October when we were ticking along this 25 reading, whereas we're back up to 75 now. So the preceding slide notwithstanding about how the market performs after the end of a hiking cycle, when we look at some of these sentiment readings, it would seem that at least a fair amount of this optimism has already sort of found its way back into the market. Will, anything to add on this front from your perspective?
Yeah, I think it's obviously a very interesting market environment. They tend to say history doesn't seem to repeat itself, and I would tend to think that investors are kind of anchored in the last bull market, the market per se too. Everybody is expecting rates to go lower as soon as inflation goes lower, but we're in a completely different environment with regards to why there was inflation than we've ever seen before in economic history. So that kind of is going to lead, your investor sentiment scale to be a little bit more volatile than usual, I would think here. And to no surprise, with markets at all-time highs, investor sentiment ticking back towards higher readings makes a lot of sense to me.
Mm-hmm. Maybe let's stick on the macro for a minute. Will, I might kick this one to you. A lot of the consternation a year ago was around how extensively the Fed had raised rates and how we had never seen a scenario where rates had been raised that much that quickly and not had a recession. Why haven't rates had a more negative impact on the economy, in your opinion?
Well, that's a great question. And kind of back to that little history comment I made a second ago, is you have to think about what caused this inflation. And simply put, there was tons of money thrown around to get us out of the COVID crash. And, from unprecedented, on the Fed side, but also the fiscal side with the payroll protection program and other government programs to help get the economy going back again after it was shut down. And that has led to an overabundant supply of cash. So it's a supply side inflation. And to contain that, the Fed is trying to reduce demand. And it's hard to reduce demand when both consumers and corporations are sitting on piles of cash. Most consumers have hopefully, either bought a house or refinanced a house at generational mortgage rate lows. So, that's why the impact of having higher mortgage rates right now isn't dampening the economy. And companies are in good position too. We saw, last year there was supposed to be a recession and earnings were flat. So companies got through corporations made it through all right too. So we're in this, potential environment where the Fed's hopefully threaded the needle with a no landing scenario. Still not out of the woods yet, but long-winded way of saying that, basically a lot of cash, a lot of supply of money out there has actually been a good thing for everything except inflation and helped everybody weather the higher prices.
Yeah, so a very obvious and unique reason as to why we are in the inflation situation. Eric, maybe you can elaborate on this. In addition to the monetary policy, the economy is pretty strong. What are you seeing in terms of the macro data that gives you either confidence or concern with respect to the state of the consumer?
Yeah, I think there's some on both sides of the house there. The slide that you're showing right now exudes confidence. I think succeeded the Fed's wildest dreams of being able to raise rates as much as they have and not cause unemployment to tick back above 4%. I mean, frankly, that's pretty remarkable that it hasn't taken place so far. And at the same time, wage growth, what those wage pressures that were just outrageous, even just 12 months ago, are starting to ease, and that wage growth rate is faltering back down towards the long-term average of 4%. If we can have 4% unemployment and 4% wage growth, I think you're going to ultimately have more happy consumers. But when we look underneath the surface on the next couple of slides there, we are seeing some cracks in consumer behavior. So a lot of that excess savings, as Will mentioned, has been spent down. That's reflected in that blue mountain chart on the top right. You can see that savings has been largely exhausted, especially for the lower and middle income households. And what that's resulted in is a couple of things. Number one, people are having to dip back onto credit cards at ultra high interest rates. At the bottom right-hand corner, that revolving debt's picking back up. And the other place that it's being sacrificed is people's personal savings rates. They have to pay more for the things that they need, whether it's groceries or fuel or things for kids. We all have plenty of those. That 4.6% savings rate is half the long-term average. So what people are actually putting into savings accounts, putting into investing accounts, 401k plans, and we know as investors that that's not really sustainable. So that is a little bit alarming. And then I would just close with on the next slide that you've got there on consumer finances, some of those trends that we're watching. So a lot of these levels, and we've highlighted it there at the bottom right-hand corner, the flows into early delinquencies. So people falling behind on auto loans, on credit cards. Student loans were sort of a moot point for a while with the suspension of payments, but does that kick back on? These levels aren't back to the troubling levels that they got to in 2007, 2008, certainly. But if that trend continues upward, that can certainly have some negative push through in the broader economy. And especially if that happens at just the same time when unemployment, if it does tick back up to 4.2, 4.3%. Since we are such a consumer-driven economy, we just want to be mindful of those things. So I guess in summary, a lot of positive signs. Looks like a soft landing at this point, but we still want to be mindful of the possibility of that delayed recession and the delayed impact of these rate hikes.
So let's kind of ask the obvious question: are we going to have a recession or not? Well, maybe you can talk to us about what the macroeconomist world thinks of that question.
Well, based on the chart right here, it looks like a coin flip. It being 50%, so heads and tails have equal probabilities. I mean, most economists thought there was going to be a recession last year. They're kind of kicked the can a little bit down the road, so maybe it might happen this year. It's hard to tell with the markets. It's always been one of more try to react to news that you have versus predict news that may be in the future. But if you want me to put my probability on it, it's probably 35%, maybe 1/3 chance of a recession.
Mm-hmm. Seems like it needs to go one way or the other.
Yeah.
50-50 is not much of a call. Well, that leads us to kind of the next topical issue facing the markets. It's an election year. I think we're all kind of gearing up to have our media streams dominated by political ads. But if we think about it from a investment retirement account standpoint, Eric, maybe you can take us through what we think the election, what kind of impact we think the election will have on the markets.
Yeah, thanks, Scott. I know we've got a slide that answers that very directly here in just a minute, but the first one I wanted to cover here is just a kind of something stark to me. If you look at these lines, it shows you consumer confidence by political affiliation, the Republicans in red, of course, Democrats in blue, but that blended total line in gray. If you look at that 19% of people who now rate economic conditions as okay or good or excellent, I guess, not just okay, 19% is below those rates that it was during the peak of COVID in 2020. So that just tells me that people just hate inflation. So no matter how good we can tell them the CPI numbers look relative to last month's CPI numbers, or that an unemployment rate's good and wage growth is fine, people are still irritated that that basket of groceries that used to cost $100 now costs $140. And first-time home buyers that feel priced out of the market, both with skyrocketing home prices, no inventory, and now higher interest rates, are not going to rate the economy as good or excellent. So there's still some negativity there, but I would also point back to where your bright green cursor has illustrated. The last time that we had this such negative sentiment was a pretty good bull run for markets from 2009. And it just shows you that investors take a long time, I think, to trust the economy again after things go poorly, which they certainly did in 2022. But related specifically to the election year, we have a slide on the next page here that just shows the average return of the markets. I won't spend a whole lot of time here, but suffice to say that the S&P 500 has done well in any environment over time, whether it's GDP growth, S&P 500 growth, whether it's a Republican-controlled government, Democrat-controlled, or divided government. You know, there's certainly trends and sectors that we want to be mindful of. We don't want to be dismissive of the political turmoil that could take place one way or the other. There's always going to be people that are unhappy. But we still want to maintain a long-term perspective as investors. So the last slide, and then I'm going to turn it back over to you, Scott, just shows, you know, maybe a little bit more visually to be responsive to your question, because the data does support the idea that election years can be volatile, particularly in the first 4 to 6 months of the year. And so when we take into account the incredible run that we just had into the fourth quarter, the fact that we're in this election year, it wouldn't be unprecedented at all to see some volatility and some chop. But what this chart is interesting, it shows is essentially once the primary season is over, when that first round of uncertainty is removed and we know who the two candidates are going to be, things tend to start looking a little bit better. And then once the uncertainty of, again, who's going to win the presidency, you know, once that is removed, it's been a very good time to be an investor post-election. So anyway, Scott, I'll let you kind of bring that home. But our messaging to people is we acknowledge the uncertainty. We acknowledge the discomfort that one candidate or another might provide to any given household. But at the same time, from investors, we want to make sure we remember we're investing in good companies. We're not investing in politicians. We're investing in ingenuity and growth and opportunities. So Scott, I'll let you kind of bring that home.
Yeah, I think Eric's point is a good one. We're not investing in the government. Or even the people that run the government. We're investing in the American economy. And what we spend a lot of time looking at and thinking about is the American economy remains undefeated over the long term. When you combine US demographics, natural resources, free enterprise capitalist system with the deepest and most liquid capital markets, plus laws and governments to enforce property rights, you end up with a stunningly positive combination, irrespective of who's in charge. And this last slide, we think, summarizes that in the best way possible. Whether it's blue or red, the markets over the long term perform quite well because of the dynamic and successful nature of the US economy. So over the long term, don't get caught up in some of the nonsense that comes with election years. Stick to your investment plan, keep saving, and you will end up in a great spot longer term. Eric, Will, anything to add before we wrap it up?
I don't think so. These are a lot more fun when we're reviewing markets that are up versus down significantly. So thank you all for joining us here, and know that we'll be here regardless of what the result is to talk through it next quarter.
Absolutely. Well, thank you everyone for joining us today. We will be back in about 90 days after Q1. In the interim, a couple of events just to make you aware of. On January 31st, we have the Fit for Learning, Mapping Out Your Financial Journey webinar. It's just a 30-minute time block. Scan the QR code for that one. On the 13th, we have our QPA ERISA Attorney Talk, which will be an hour long, a little bit more in depth. That's on the 13th. And then finally, the next Fit for Learning session, deciding between saving or paying down debt. That's another half-hour session on February 28th. So please join us for any one of those, and watch your email box for an invite for next quarter's Making Sense of the Market. Thank you, Will. Thank you, Eric, and everyone. Have a nice day.